One of the most frustrating things for a trader is when he's up big money on a trade, doesn't take his profits, and then ends up not only losing all of his profits, but adding insult to injury, actually taking a loss on a trade. I'm Seth Freudberg, the head trader of S&P Capital's options trading desk here in Manhattan, and our traders here are trained to analyze the risk-reward relationships, not only at the beginning of a trade, but also at every point during the trade. In this video, we're going to be teaching you a technique for scalping the profits out of an options trade so that you can avoid giving back your profits and instead keep them for yourself. So stick around. I think you're going to find this important. Hi, I'm Seth Freudberg. I'm the head trader of S&P Capital's options trading desk. S&P Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so I'm guessing that just about anyone out there watching this video has had that gut-wrenching experience of being up big money on a trade and then giving it all back and actually taking a loss when in retrospect it would have been very easy to pocket your profits earlier in the trade if you had been thinking more clearly. And with options income trades that professional traders make, there are really clear opportunities to book profits before they evaporate, and professional traders are trained to seize on these opportunities to avoid that awful feeling of waiting too long to take your profits on a trade. So to demonstrate how this is done, let's go back in time to the final quarter of 2018, which is a time in the market where a steep sell-off occurred right around October 1st and continued pretty much until the end of the year, as you can see on this price chart, which is a snapshot of the prior 3 months taken on December 17th, 2018, where the S&P 500 index, known as the SPX index, was trading at 25.52. Now, before we get into the specifics of how to scalp profits out of option strategies, I wanted to mention that if you want to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so in order to teach you how the scalping technique works, which we're going to do through an example using the S&P 500 index options, we're going to do a really quick review of how index options work. Just hang in there if you already know this stuff. This is going to be quick, and then we'll jump right back into teaching you this scalping technique. All right, so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call's strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of that put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 30 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75, but the 4,000 puts would expire worthless because the market didn't close below that 4,000 strike price. Okay, so now let's go back to December 17th, 2018, and with the SPX index trading at 25.52, as we mentioned, we'll go ahead and sell 10 calls up at 26.60 expiring at the end of January, and we'll also sell 10 of the 2330 puts expiring that same day, the last day of January. And then simultaneously, we'll buy 10 of the 2680 calls, 20 points above the calls we sold, as protection. And we'll also buy 10 of the 2310 puts, which are 20 points below the 2330 puts we sold, again for protection. Now, when we enter into a trade structured this way, selling calls and puts closer to an index price, which in this case is 25.52, and buying calls and puts farther away from that index price, that entire structure is what is known as an iron condor to option strategy traders. Now, let's break down what's going on here before we jump into the scalping discussion. You see, an iron condor, as we mentioned, is a combination of a short and long calls and short and long puts. So just focusing on the calls for a minute. When you sell a call closer to the market price and buy a call farther from the market price, that particular combination is called a call credit spread. And the other side of the trade, where you sell a put closer to the index price and buy a put farther from the index price, that's called a put credit spread. So let's look at the cash flow first of the call credit spread. And as you can see, we received a price of $29.50 for those, but remember, they pay off $100 per point above their strike price of $26.60. So we multiply that by 100, and we sold 10 of them. So we receive a total of $29,500 for those. And the long calls up at $26.80. For those, we paid $24.03, resulting in a cash outflow from our account of $24,030, as you can see from the calculation, resulting in $5,470 of positive cash flow flowing from the call side of this trade. And using the same basic logic, selling those 2330 puts brought in $19,200, and buying those 2310 puts cost us $16,850, and so that creates a net cash inflow of $2,350. So when we combine the cash flow we received from the two spreads together, that becomes the cash flow for the entire iron condor, and that is $7,820. Your broker, incidentally, is going to be requiring you to set aside $12,180 in capital for this trade, which is also its absolute worst case scenario. Okay, so now let's move to December 24th, Christmas Eve, and by around 12:45 that day, the market had sold off all the way down to below $2,400, down to $23.66. And so let's zero in on the call side of our trade. And as you can see, the 10 2660 calls that we sold for $29.50 have dropped to a price of $4.10. And the long calls we bought up at $26.80 for $24.03, those have dropped to $2.98 in value. And so at this point, experienced options traders recognize that there's an opportunity to scalp the call side of this iron condor. You see, experienced options traders understand that the absolute most you can make out of a call credit spread part of an iron condor is the original credit of $5,470 on that credit spread. Why? Well, think about it. At any SPX price below $26.60, both the 10 short calls at $23.60 and the 10 long calls at $26.80 both expire worthless, right? Because the only way they pay off is if the index closes above their strike price. So if that were to happen, then we just pocket the entire premium we received for that spread. But if the index closed above $23.60, we'd have to start making payments out of those 10 calls we sold at $23.60 at a clip of $100 per point for each of the 10 calls. And so whatever payments we make under those 2360 calls cuts into the profit we can make on the trade, because we start giving back some of that original cash flow that we received in the first place. And so what smart professional options traders do is to close any spread, whether it's a call spread or a put spread, if you're able to make at least 80% of the original credit cash flow that you received at the beginning of the trade. And so starting with that original 5470 we received for the call credit spread, let's suppose we wanted to calculate whether we could receive at least 80% of the profit from the call credit spread by closing the trade now. And so first we'll take a look at what it would cost to buy back that 2660 call. And we can see that call is now trading at just $4.10, resulting in a cost to close that option position at $4,100. But remember, those 2380 calls still have some value. So we sell them off and we actually receive back $29.80 for those. And so after closing that side, we would have made on the call credit spread side of the trade just about 80% of the maximum possible profit on that side of the trade, bringing it to $4,350 of profit by closing it. And so we have effectively scalped that side of the trade. And I want you to think about what that means. See, we have no more calls. They're closed. And so if the market bounces, it's immaterial to us because we have no long or short calls to worry about. They're gone. And so if the SPX index closes anywhere above 2330, as we explained before, both the 2330 and the 2310 puts expire worthless, and we keep all the cash flow from that part of the trade as well. And so now let's move to January 10th. As you can see, the SPX finally started to bounce in late December and rallied back up to 2596. And so now let's take another look at what's left of our iron condor, which remember is just the put side. And as you can see, this time the puts have lost most of their value, with the 2330 short puts priced at $3 and the long 2310 puts valued at $2.58, which makes sense, right? Because the 2330 puts that we sold only pay off if the market closes below the 2330 puts, and it's trading more than 250 points above 2330 with only 22 days left before they expire. And so they're not going to be very valuable. And so let's do that same calculation as we did to scalp the call side. And as you can see, starting again with the 2350 in initial credit that we got, we subtract out the 2330 put for $3, resulting in a cost of $3,000, and we add back the 2580 we received for selling off the 2310 puts that we bought, and we net it all down, and it comes to a net profit of $1,930 on the put side of the trade, which, as you can see, exceeds the 80% of credit guideline that we set forth for ourselves, closing the credit spreads that comprise the iron condor. And so the full profit we made on the iron condor is the sum of the amount we scalped out of the call side plus the amount we scalped out of the put side, which comes to $6,280, a profit of more than 51% against the original required capital. And one more thing, in order to drive home the importance of scalping iron condors, closing them when you've squeezed 80% out of each side, like we did in this example, I'd like to call to your attention what eventually happened to the SPX index that month. And as you can see, by the end of the month of January, SPX had bounced all the way up to 2704. So let's suppose you had not scalped the trade, but instead just hoped and prayed and essentially got greedy. Well, here's exactly what would have happened. So again, starting with the full original premium that you received for the entire condor, you then have to calculate how much you'll need to pay, and that's determined by how much the number 2704.10 exceeds the call strike price of 2660, which comes to 44.10. And so you multiply that by $100 per point, and we sold 10 of them, and so that results in a payout of $44,100 from your account just for those calls. Now you do get back $24,100 for the calls you own up at 2680, but since those are only $24.10 in the money, you make $20,000 less on those. And so when you net it all down, you have this huge loss of $12,180, whereas by accepting 80% of the gain by scalping both sides of the iron condors, the market first sold off and then bounced, you were able to make over $6,000 in profit. And so what I'd like you to take away from today's video is that when trading options credit spreads, and an iron condor is really a combination of a call credit spread and a put credit spread, whenever you can close a credit spread which will leave you with a profit that is a high percentage of the original cash flow for that spread, then you should seriously consider exiting the trade. Why? Because once that side of the trade has shrunk to a very small cost to close it, then you can lock in your profits on that side and not have to worry about the market making a move adverse to that side of the trade anymore. At that point, the remaining reward left in the trade just isn't worth the giant risk of losing all of that profit and risk actually taking a loss when a handsome and totally rewarding outcome was at your fingertips, but you got greedy. This is the kind of mistake professional traders rarely make, and you should consider applying this principle to your trading as well. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.